Hi guys, Lucca here, the market logician. Today, we are diving into a company that sits right at the intersection of technology, advertising, and efficiency, Integral Ad Science, or AIS. If you have ever seen an ad online and thought, does this even reach real people? That's exactly the kind of problem AIS solves. And in a world where every company is trying to do more with less, tools like this aren't optional anymore. They are essential. I will show you how AIS fits into the digital advertising ecosystem, why I think it is still flying under the radar, and how my valuation model suggests the stock could go up more than 40% from where it is today. Let's jump in. Founded in 2009, AIS is a tech company that helps brands and agencies make sure their ads are actually doing what they are supposed to do. AIS's main goal is to ensure that ads are shown in the right places to real people and in safe environments. To make that happen, they use data analytics and artificial intelligence to check if ads were truly seen by humans, whether they appeared alongside appropriate content, and if they avoided invalid traffic, like bots. On top of that, AIS gives advertisers detailed performance metrics, helping them make smarter decisions and get more return from every dollar spent
Let's
on
say
ads. Coca-Cola wants to run a new ad campaign. First, they hire a marketing agency to manage the campaign. That agency now has to decide where to place the ads, and they basically have two main options. Platforms like Google, YouTube, or Instagram, digital environments that host and distribute ads, or publishers like NFL, Bloomberg, or other content creators that open up space for advertising on their sites, apps, or channels. AIS plays a key role for all of these stakeholders. For advertisers, AIS confirms that ads were actually seen by real people in safe and relevant environments, and that the impact of the ad was measured accurately. For agencies, provides real-time data to track ad performance, helping them adjust strategy and optimize results on the fly. For platforms and publishers, it helps measure the quality of ads shown, making sure they meet key standards like viewability, brand safety, and fraud protection. Now that we understand AIS's business model, we can start to see its real potential and why I believe this stock is worth a closer look. Reason 1. Market conditions are really working in its favor. Every company is constantly looking for ways to cut costs and boost margins. And with marketing budgets under pressure, according to Wall Street Journal, 73% of CMOs say they need to do more with less, and 64% are facing real budget cuts. Eliminating waste has an immediate financial impact. That's where AIS comes in. It offers exactly what every player in the ad chain needs, a tool that boosts ad efficiency and reduces marketing spend. In today's macroeconomic environment, with more uncertainty and tighter budgets, that kind of solution becomes even more valuable. It's not just a nice to have, it's a cost-saving catalyst. Reason 2. New products. AIS is continuously expanding its product lineup, and tools like DPP and quality attention stand out. Dynamic performance profiles helps advertisers understand which media paths drive the best performance, so they can optimize spending, eliminating low-quality inventory. AIS quality attention goes beyond basic viewability and measures how much real attention an ad gets, offering deeper insights into ad impact and effectiveness. Reason 3. New partners. AIS has been steadily expanding its network of media platform partners, and that's a big deal, a really big deal. These partnerships allow AIS to offer advertisers and agencies more flexibility in pricing, better targeting options, and consistent ad quality across multiple platforms. The more platforms AIS integrates with, the more valuable its ecosystem becomes, creating a strong competitive moat. And this isn't just theory. Partnerships with giants like YouTube, Meta, TikTok, and Netflix allows AIS to sit at the center of where digital attention is happening now. It means AIS can embed its tools directly into the environments where ads run, making its data more actionable and its services harder to replace. Now let's get to what is more important for us. The numbers. Reason for financial performance. When we combine everything we've covered so far with AIS's actual financial results and projections, the company starts to look very, very solid. AIS breaks down its services into three core segments: optimization, tools that help advertisers ensure their ads are safe, shown in the right places, and actually seen by real people; measurement, solutions tailored for agencies. This includes audience segmentation, best practice, and actionable insights on timing and ad placements. And publisher tools, features that helps publishers analyze the type of content their ads appear next to and verify that human agencies are actually viewing them. Together, these pillars form a comprehensive offering that serves outside of the digital ad equation and drives consistent revenue growth. All three product segments, optimization, measurement, and publisher tools, are performing well. From Q4 2024 to Q1 2025, each of them showed revenue growth, which reinforces that AIS's full-stack solution is working effectively as a group. Key financial indicators continue to improve, and most importantly, the company's profit margins, measured by adjusted EBITDA, keep growing. So AIS isn't just expanding, it's becoming more profitable and operationally efficient. On top of that, international revenue continues to rise, showing early signs of global traction. Even with that international growth, AIS still gets about 68% of its revenue from the USA. That means there is plenty of untapped potential overseas, and as they continue expanding globally, that could become a major growth driver. It's also worth noting, AIS went public in 2021 and peaked in 2022, but since then, the stock hasn't really climbed back to those levels. In other words, the market may not be fully pricing in the company's strong execution and improving fundamentals. To close things out, I run a discounted cash flow model to estimate AIS's fair value. For the first 3 years, I used Wall Street analyst estimates from Market Screener. Then, I assumed a transition period with an average growth rate of 12.7% over the next 3 years. After that, I brought the growth rate down to 3%, which is in line with long-term DCP growth, a common assumption in discounted cash flow models. To calculate the cost of equity, I used the CAPM model with a beta of 1.56 and a market risk premium of 6%, which gave me a cost of equity of about 13.7%. From there, I arrived at a WACC of 13.45%, which I used to discount the cash flows. Putting it all together, the value of the business comes out to around $2.03 billion. After adjusting for non-operating assets and debt, the equity value is about $2.07 billion, or $12.57 per share. When we compare this to the stock currently trading at $18.99, AIS appears to be undervalued by about 40%. Assuming these assumptions hold, especially the cash flow growth, the stock has significant upside potential. And as we've seen throughout this analysis, that growth seems not only achievable, but highly likely. So, with all these positive factors, I'd say I recommend... Just kidding. Technically, I can't recommend a stock. I'm just a market logician. But the facts and my perspective are on the table. You decide. Just make sure it's your decision and your risk. If you found this breakdown valuable, make sure to hit the like button, subscribe to the channel, and turn on notifications. This level of research takes a huge amount of time, but it's all here to help you invest with logic, not hype. Thanks for watching, and I will see you in the next one.